Here's something interesting. The Federal Reserve just cut interest rates. Okay, but the stock market is hitting all-time highs. It feels, well, contradictory, doesn't it?
It really does. It's not the typical scenario you'd expect to see.
So today, we're diving deep into that exact decision. The Fed's move on September 17th, 2025, starting a new easing cycle, cutting rates by 25 basis points. The target range is now 4.00% to 4.25%.
Right.
Our mission here is to unpack why this feels so counterintuitive with the S&P 500 doing so well. We want to explore the ripple effects for you, for businesses.
And maybe look at history, right? See if this hints at a soft landing or maybe something less smooth.
Exactly. So let's talk about this balancing act. First cut of 2025, but the S&P is, like you said, at record levels.
Yeah, it's quite the setup. The Fed themselves called it a risk management cut. Think of it as an insurance policy, basically.
Insurance against what, though?
Against the labor market getting worse. They pointed to slowing job gains, unemployment creaking up to 4.3%. It's a preemptive move, they argue.
Okay, but hang on. Inflation's still high, 2.9%. How do they justify cutting rates now? Isn't that, I don't know, pouring fuel on the fire?
Well, that's the tightrope walk. Powell admitted, pretty frankly, our tools can't do two things at once.
So they're choosing?
It seems like it. They're signaling that right now employment risks outweigh their inflation concerns. They're willing to tolerate inflation staying above target for a bit longer.
And was everyone on board with this?
Not entirely. It was an 11-to-1 vote. One member actually wanted a bigger cut, 50 basis points. And the dot plot, their forecast for future rates, it showed a really wide range of opinions. So definitely some disagreement internally.
Okay, so let's bring this down to, everyday life.
Yeah.
What does this rate cut actually mean for regular people, for consumers?
For you, the consumer, it's kind of a mixed bag. If you have variable rate debt like credit cards or HELOC, you might see some gradual relief eventually. Borrowing gets a tiny bit cheaper.
Which is what the Fed wants, right?
Yeah.
To boost spending.
Exactly. But if you're a saver, it's not great news. Returns on savings accounts, CDs, that kind of thing will likely erode further.
And for businesses.
For businesses, it lowers their cost of borrowing money, their cost of capital. The idea is to encourage them to invest, maybe hire more, which would help shore up that cooling labor market we mentioned.
So consumer spending and business investment, they're hoping this nudges both.
That's the plan.
Are certain sectors more affected than others by this?
Oh, definitely. Housing and construction are always very sensitive to interest rates. Lower rates should help builders finance projects, but you've still got big structural issues, not enough houses being built, and that lock-in effect, people with super low mortgage rates aren't selling, so the rate cut might not fix everything there.
Right. And you mentioned this tightrope walk.
Yeah.
Does this raise the risk of stagflation?
It certainly brings it into the conversation. That toxic mix of a stagnant economy and high inflation, it's the Fed's worst nightmare, really.
Yeah.
Makes their job incredibly difficult.
Okay, let's talk about the market reaction. It was fascinating. A bit quiet at first, then futures just shot up to new records.
Yeah.
Why? What's the logic there?
Yeah, it's classic bad news is good news for the market sometimes. The core logic is simple. Lower interest rates reduce the discount rate used to value future company earnings.
So future profits look more valuable today.
Exactly. It mechanically boosts stock valuations, especially for growth stocks whose big earnings are expected further out. Plus, you have the sort of psychological factors.
Like the Fed put.
Right, the belief the Fed will always step in to save the market. And Tina, there is no alternative. If bond yields are falling because of rate cuts, where else does money go? Often into stocks.
But surely there's a downside risk here. The market's already high.
Absolutely. Valuations are stretched. The S&P 500's price-to-earnings ratio is hovering around 25, which is historically quite high. Investors are paying a premium.
So if the economy does weaken significantly,
and corporate earnings start to fall, that could easily overwhelm the boost from slightly lower rates. The fundamental weakness could pull the market down, regardless of the Fed's actions. That's the economic cliff people worry about.
history must have some lessons here. What happened in the past when the Fed cut rates while the market was near its peak?
History shows two very different outcomes. It's stark, actually.
Okay.
Sometimes, like in 1995 or maybe 2019, the cuts were like that insurance policy that worked. A slowdown was feared, the Fed acted, and the economy achieved a soft landing. The S&P 500 did really well afterwards, like over 30% returns in the year after the 95 cut.
Okay, that's the good scenario. What's the bad one?
The bad one is 2001 or 2007. The rate cuts then weren't insurance. They were the start of the Fed reacting to a recession that was already beginning or about to hit hard.
And the market.
The market collapsed. The S&P 500 lost over half its value after those 2007 cuts started. So the stakes are incredibly high depending on which path we're actually on.
So the key isn't just that they cut rates, but whether the economy actually avoids that deeper downturn. It's about the follow-through.
Precisely. The rate cut itself is just a signal, or maybe a tool. It's the underlying economic health that determines the outcome for your investments.
So wrapping this up, as we stand right now, is this cooling just a manageable soft patch? Or are these cuts the first sign of something more serious brewing for the economy and for your money?
That's the multi-trillion-dollar question, isn't it?
Yeah. So for you listening, keep a close eye on those key indicators. Things like jobless claims, core PCE inflation, the Fed's preferred measure, and really crucially, watch corporate earnings revisions. Are companies becoming more or less optimistic?
Those numbers will give us clues about which historical path we might be following.
And here's a final thought. Given this incredibly narrow path, the Fed is trying to walk cooling the labor market without crushing it, taming inflation without causing a recession. How long can this market optimism keep running ahead of the fundamental economic data before reality bites? It's something to really think about.